Welcome to That Annuity Show, the podcast that will make you an expert in explaining annuities to your clients. Give us 30 minutes each week and we'll shave hours from your client presentations. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. And we've got our full contingents of my co-hosts here and present in various locations. Will Moorcroft, good to see you. We missed you last week.
Good morning.
Yeah, what were you doing? CrossFit last week?
No, there's as with everyone, there's a lot going on. So I was unfortunately unable to attend, but happy to be back.
Yeah, no, we missed you. Ramsey, good to see you.
Great to be here.
And Mark, do you want to and please do the honors of introducing our guest today?
Sure. Good morning, Paul. Thank you for having me. And Josh, thanks for joining us. I know you and I think first met 5-6 years ago at an industry event. And I would say you're really an industry icon at this point. You're on TV all the time. You've got an extremely successful industry agency. And I know that your entrepreneurship really goes way back to even your high school days. You started off with a very successful lawn business. In college, you did an online collectible business. You also kind of ran a construction company that built lofts for college students in their dorms. And then obviously went on to build a very successful agency. So you want to just, I guess, tell us a little bit about your drive and like what kind of brings that entrepreneurial, push from you and really kind of where you see the industry going.
Yeah. Tell us this backstory. How did you get... Take us to the point you got on television.
Well, thanks for the introduction. I don't really work a lot. I only work half days. I call them 12-hour days. But selling Beanie Babies online when I was in high school to, I guess, where we're at today with over $3 billion in sales with a retail industry agency. There's a lot of moving parts. So I can tell you that marketing this business is all about marketing, and marketing is always changing. So what worked 3 years ago doesn't really seem to work as effectively or as efficiently as it does today. So if you're not changing, then eventually the numbers will change over a period of time. But the short answer to your question, I was just in personal production, just like a lot of the advisors out there. And I started doing one seminar a week, and then went to 2, and then 3 and 4. And I think at our peak, we did maybe 21, 23 seminars in a month. So what I learned a long time ago, the more events that you do, the more meetings you have, the more money you raise. It's kind of that simple, a lot of work, but you got to find that diminishing return, and you do get better. The harder you work, the luckier you get.
And Josh, during the pandemic, when things, early on, especially when things really closed down, how did that impact your seminar model, and what did you do to transition? And I guess, are there things that you take away from that you'll continue going forward that you may not have expected?
Well, seminars we have stayed away from probably for about 8 years or so. We've always got in and out of them throughout the last 8 years just to be current in testing. We truly believe that face-to-face is the biggest impact in conversion because the clients are buying trust. And there's two types of trust. There's trust. I trust you that you are the best person for me in the life that I'm at today. The other type of trust is, do I trust that you're not going to hurt me? Do I trust you like my brother, or maybe your brother wants to hurt you? But and I think the biggest impact is when you do see people face to face. Now, obviously, COVID has changed the way we do business, and now we try to do a hybrid approach between a face-to-face event as well as a virtual event, and that could be a series of Zooms and things of that nature. So, a little background: we transitioned from seminars to online digital advertising. And we got so many people that we watched our videos, I think 14 million times, and they'd opt in for white papers to see if an annuity is right for them and what would that look like for them. And so they were kind of pre-sold with watching videos and reading the documents. They had several white papers involved. So people would call in, and almost every function of the company I would do personally myself, except for maybe coding, whether it's setting the appointment myself, or doing the presentation, or writing the documents, or following up on the lead. And so doing virtual sales or virtual asset gathering, we started about 10 years ago, and we were doing about 100 million sales a year over the phone, and with about half a dozen advisors or insurance agents that were licensed in all 51 jurisdictions. So it's not impossible to do it. What we found, Mark, is when we actually saw them face to face, like in person, the conversion of the dollars per meeting was almost 2 times. And that's a big difference. So it's not that you can't do it virtually. It's just that you have to change your process to more steps. They're more condensed steps, more efficient steps in face to face. But there's nothing as impactful as face to face as there is virtually. So today, when the COVID hit last March, we basically said, okay, we are going to roll out new sales training that works that we used to do. It's nothing new to us. We raised hundreds of millions of dollars virtually, raised even more face to face. And we have to roll out a 7-step process versus a 3-step process that would be face to face with a little bit extra touches. And there's a learning curve. So it is learned. It's just a lot more follow up and a lot more steps and a lot more shorter meetings to get the end result.
Yeah, and I guess before we kind of get to even to the digital stuff, Josh, I mean, your transition. So you're doing seminars. You're doing a lot of them. You probably at some point said, "I'm really good at this," and said, "Well, how do I amplify my my business?" Now that would have been, back a ways. Did you? Why television? I mean, did you try radio? Did you try direct mail? I mean, what? Maybe take us through your thoughts, your experiments, and why you ended up with the format you did.
Yeah, so we had a presentation that worked very well in live events. You put 100 people in a room, when they nod, when they connect. So we took that to camera and we did it interview style. So we hired a couple of hosts that might have been on TV, news channels or something in that nature, and they'd ask the questions, and it would be Q&A. And if they wanted more information, they would ask and request for the information kit online. So driving a lot of traffic towards digital marketing did work. Now, in any category, you do get diminishing return, meaning your ROI continues to drop. So finding other median channels to market was key to be diversified and also for future growth. So I'll give you a quick example. So right now we are doing digital advertising. A lot of our spend is spent in financial shows in the deal market area in certain cities where our better advisors and agents are. And then we also do short form. Short form is 2-minute, 1-minute commercials as well for information kits. Well, those are 2 different types of advertising: sending traffic online, opting for a funnel with outbound dialing to a prospect. Where if they're watching a 30-minute financial show, if they're watching a 2-minute information, and you have live trained account executives, we call them, where they set financial meetings with prospects and advisors, then the likelihood of them to convert to an appointment can be higher. So generally speaking, online presence, they're more pre-informed, people that go through the online funnels. On TV, if it's a short commercial, they're less educated. However, the trust factor is higher. So if you can contact the prospect via TV, radio, and digital, and all 3, you seem to get a higher lift. The other comment I'll make is marketing does have seasonality. So, for example, Medicare, Humana came in this year and increased their budgets by 8 times. And they were spending like 4 times more than they did previous year. So it became a bidding war, especially on TV. So we quickly opted our marketing budgets to a different channel. So now we got this kind of dialed in to where if it's like oil, if oil's high one quarter, it might be lower another quarter. It's asset allocation with those media dollars, but lead scoring, those funnels are critical. One of the things I've been studying with top advisors, the advisors that have omni-channel marketing, that means just more than live events, more than just radio or more than just digital presence. Those are the ones that have been able to thrive very well in this business. The ones that have only had one trick ponies, they've really struggled. So sales have done fairly well, I think, this last year because it's forced advisors to go back to existing clients that maybe there's more money there. Or number two, they met with people that they didn't do business with, and they were following up with those. But new client lead acquisition for most advisors that are doing less than $10 million of premium production a year have really taken a hit over 50%, in my opinion.
The hit as a direct result of the pandemic?
Yes, because they're dependent on one channel, and they said, this works, it's not broken, let's not, let's keep going. Where they've gotten their production is going back to existing clients and asking for referrals. But if at some point that will dry up, that well will dry up if they don't get back into new client lead acquisition, new client lead generation, that works. And it could take 6 months, it could take a year to get a working funnel. So I could tell you it took me 2 years to finally get TV to work. It didn't back out for a long time, but it kept testing and lead scoring and optimizing. But it could take a long time, and making sure the proper budgets are in place and the focus, because it's not so much the media channel. It's not that digital is better than live events or TV or radio is better. It's how well that funnel and the customer's experience is, and the lead score within that funnel.
So not only do you need a good strategy, you need patience, Josh, right? To build a system that works.
Business is it's a math problem, and if you're really good at math, then you can do well. Unfortunately, a lot of great advisors out there are really strong at connection and building client relationships and building trust, and they're good at presentations. Then they don't look at the actual data, and it takes a long time to accumulate that data and see what works and what doesn't work, and analyze it. And so we spend a very high percentage of our time analyzing what's working, what's not. Is it trending up? Is it trending down?
So, this is very interesting because there's time, and time in and of itself is money. Plus there's investment in building out the funnel and the various channels and iterating and experimenting. What do you think it takes for somebody to get started in this business? How much capital do they have to start with to make this work? And by falling on that, like these agents that are currently struggling, like how much capital do you think they're going to need to actually turn things around?
Well, this business is all about marketing, sales, and ops. Those are the three categories. And if you're not in front of people, you're probably not raising money. And that's what most advisors are very strong at doing, is being in front of people to help them. The marketing component, they can either find somebody or a partnership or a company that has proven marketing channel that works, and getting referrals from other advisors that actually get it to work, or they can try to create themselves. In business, what I've learned a long time ago is everything seems to cost twice as much and take twice as long as I would like it to. It did take me, when I broke through seminars to digital online marketing and finally became dependent where I can actually leave seminars, it was about $1.8 million in testing. It was a lot of money. It's like all the money I was making and doing, set live events at the time. It costs a lot. Now, once I had a working funnel, it's just an autopilot. And then run that for a few years, and then I added another funnel, and that format was more of an inbound marketing strategy with TV inbound calls versus just outbound calls with digital opt-ins with different people. I know a lot of people will focus on cost per lead, and not all leads are equal. You can get very low expensive leads on Facebook, but the lead quality score historically has been very, very poor, where a Google search would be people that are shopping for rates. The lead quality score would be very, very, very high, but there's limited supply in search. People don't wake up in the morning saying, I can't wait to buy an annuity. I wish that was the case, but the reality of it is annuities are sold, they're not bought. I wish, even though they have tremendous value for the prospects, the number one reason people would not buy or set an appointment, should I say, with a financial professional pre-COVID was there's no financial sense of urgency. The market's been on a war, straight up for the last 11 years. The number two reason people would not set a meeting with a financial professional is that they already had a financial advisor. Today, it's changed. Today, there is a financial sense of urgency. People are concerned. The number one concern on boomers is a stock market crash. Number one is running out of money. Number two is stock market crash. Number three is how to pay for medical expenses. Number four just came up recently, and that is with all the printing of the money that the Fed has been doing. It's now inflation. And that's why people invest in the first place. That's why people put money in the market in the first place, is because they don't want their purchasing power to go down. So the challenge is the boomers that are within this retirement danger zone 10 years before retirement and 10 years after, they can't afford to make a mistake or have do-overs. So where do you put your money that is not going to sit in the bank and earn nothing, or you can risk it in the market and have to go back to work for 4 to 5 years or reduce your lifestyle. And that's the challenge that boomers and retirees that don't have pensions are up against today. So they actually want to meet with people. The number one reason they don't meet with people is because they're afraid of their personal health with COVID. And that's why they're hiding or behind. But with the COVID, in my opinion, has pretty much advanced people's adaptation to technology in meetings the way we do business by almost 10 years. Just because of it's forced consumers and investors that they just didn't want to change. And now it's forced them to change of how to do business.
Well, interesting. So I have two questions about your funnel. One, I think you just told us. I would expect the math has changed on the consumer willing to engage remotely and digitally. So what do you think the factor is? Like, is seniors willing to chat with you online? Call numbers, is it like 50% greater, 70% greater than it was? However you mentally think about the receptivity.
What I think is working effectively is we always say a communication is a conversation, like we're having a conversation right now. Information would be like an email or a chat. So communication is we have this chart diagram where your highest impact will be if they come to you in your office. The second highest impact if you meet them anywhere, is you meet at a resort or at the person. The third highest impact would be a one-on-one conversation like a Zoom, and then it drops like a rock when you do webinar version, and then there's preset phone conversations before that cold calling. So what we find that's working from a virtual standpoint is you ask for a very low commitment to see if we can help, and it's just a 15-minute conversation via hopefully Zoom. Not all prospects are strong on getting on Zooms or technologies. Maybe it's just a quick FaceTime so you can make that impact with your phone. Just 15 minutes and listening to them, asking questions, see what they're looking for, and if the client's expectations is 15 minutes. Then it goes in three different ways. One could be, well, I really like what you have to say. Normally, our next step would be maybe a strategy session to learn a little bit about you and seeing if there's an area of improvement. Two, we could have that strategy session set up for a time that works for both our calendars. Or three, it's just not a good fit, and so what we're seeing is shortening the sales cycle or the flow, doing the virtual conversation via Zoom. If they take the 15-minute conversation approach, then seeing if it makes sense to take it deeper for like an hour Zoom or 45 minutes at that time for more in-depth strategies. If you go straight to let's take an hour and talk about everything that you have, that's going to push people away, where people just want a little bit of information, and the small micro commitments via conversation makes a much bigger impact in this COVID environment.
Hey, Josh, how do you get the funnel to that 15-minute conversation? Like, how does that work? How does that transfer over from, the leads that you have to get on the Zoom call for 15 minutes?
Well, it starts with the ad, and it starts with the communication of that ad, and maybe it's going to be a long page written document that talks about what we do in services, and if you're interested to learn a little bit more and have a 15-minute no obligation conversation, then that can work that well. We are very upfront in our type of advertising, so there's a lot of ways to make clients. Oh, I know a lot of great advisors do Social Security maximization presentations. They will do talk about taxes and retirement, or they'll talk about estate planning. We've done all those. We've decided to go straight to the point to say, is an annuity right for you? Now, what we find is most people are truly concerned. I mean, they're truly don't understand what annuity is. There's a lot of confusion. We know what they are because we're professionals and we drink this and do know this all day. But they really are confused. Is an immediate annuity, I lose control of my money? What's the difference between a fixed and a variable? I thought I had a fixed, it has a 6% roll up on the income rider. And so we can't assume they understand what they have. And I think that, a short video or a short online video or a short, maybe a one pager on a direct mail piece, just offering them an information kit is a way to get a conversation open. And so if you can get that prospect to say, yeah, I want to learn more to see if it's right for me. I'm seeing what's out there. And then if you can get a trained, I call them account executive, or a very strong receptionist, or maybe the advisor themselves, because no one's better than the advisor or the financial professional themselves to have a conversation, just to talk about what it means to them and how we can get something custom to them virtually, and just see if there's anything there, and helping the client at ease, that we don't take clients on that first conversation. It's just to get to know each other and help you see if there's an area of improvement. If there's not, then we'll tell you.
Okay, so you've done a great job like optimizing this funnel to sell an extraordinarily complicated product. So I'll put you on the spot here, Josh. Hey, we're going to design a product for you. What would that FIA look like? Would it be simpler? Would it be a rider, but the rider looks different? I mean, what would an optimized product look like to be able to communicate it on television and even shorten that funnel even more than it is today?
Well, simple sales. If people have to understand it, and if they don't understand, they're not going to do business. So, FIAs have become more innovative. They have become a tremendous more value than in the past than they were. But if you were to do a virtual sale via, let's say it was TV or radio or digital way, the easiest is commodity-based products. So if you think about term life, you get this much benefit for this amount of dollars. It's you buy, you die, it pays. Medicare, everybody needs healthcare and they want the best rate. Understand it is a little more complex, but it's still commodity. A lot of times they don't really pay a lot of it out of their pocket. Sometimes they do, but it is kind of commodity. MIGAs are a commodity, and they're simple. They still don't understand. Prospects a lot of times don't understand the difference between a MIGA and a junk bond or a bond. Right. They really don't. They just look at a carrier's rating and they don't understand that there's a legal reserve system. There's dollar for dollar backed by reserves, and they're very well protected. And so with a little bit more education, I think MIGA sales could do very well. Clients just don't understand them and how to compare them and against other vehicles. Going back to your question with the FIA, it is more complex, and that is not something I would try to present to them in a 10-minute conversation like a MIGA or a term life insurance policy. The concept, and I would break them down into two different categories. You got guaranteed income annuities. They have high guaranteed income. They could have other great accumulation benefits and help pay for home health care, things of that nature. And then you got accumulation annuities, simplified accumulation annuities. And those are the new innovative ones that are uncapped, have high participation rates, and have low fees or no fees. And so those are designed for people that want a higher rate of return than the banks, but don't want to risk their money in the market, and to help fight against inflation. And so to help narrow that down and then use visual, visuals software via Zoom, such as Annuity Rate Watch or maybe Annuity Genius or something of that nature, helps them understand it and understand the quotes and the process. And the clients like to be engaged in that kind of format, actually go through the process. And if you're efficient at that and doing it real time and you can show it on your screen, it makes a big impact.
A big part of it's really the technology in terms of explaining it and illustrating it and showing them how it works, correct?
The highest paid people take complex things and make them simple. And so how do you take complex things and make it simple and fully disclose and make sure they understand all the good and the cons?
So I had a quick question. You've talked a lot about funnels, and while I'm definitely not asking for your specific numbers, but I want to get a sense for the audience, like what kind of sort of in orders of magnitude conversion ratio should one expect? So to get, what is a percentage range that someone should expect? That should help people in our audience understand just how many prospects they need to have to really get some meaningful sales. Like what's a reasonable range?
So we identify who is our avatar, our client avatar, and who's that we really want to focus on. And we are focusing on between the ages of 50 and 75. So 80% of the people fall in the categories of 60 and 75 years of age. Now, the older the prospects, the less likely they are as efficient and affluent in digital marketing. The older the prospects, they're watching more television, more traditional marketing. The younger prospects are very affluent and strong in understanding digital apps and mobile advertising and radio. The challenge that a lot of advisors have is the greatest asset that people under the age of 59 have is in 401ks, IRAs, which means a lot of that retirement money, live on money, is not accessible until they leave that employer or they hit 59 and a half. So we define our category into kind of two buckets. So we try to fine tune the marketing between age 60 and 75 for 80% of those people we talk to. We do have cutoffs between, I think, less than age 45 and people over the age of 85, and kind of say, okay, we're going to stay with, not go lower than age 45 and not go higher than 85, but 80% of the people we talk to need to be between age 60 and 75. So that's step one. Step two is we are not in the call it lead selling business, lead generation business. We're in the asset gathering business. So identifying who's a qualified prospect versus an unqualified prospect. It's not the easiest thing to do, because for people to share with you what they have, you got to earn trust and give them a reason why they may want to share that information. So one way we did that is we have two types of information kits. One is for people, it's called the wealth builders, for people that have less than $100,000 of investable assets outside of real estate, and the other one is the wealth accumulator information kit. And that's for people that have more than $100,000 in investable assets outside real estate. Which category do you fall into, so I can get you the right information kit? So that could be a very simplified way via phone conversation with a prospect. So you can put them into less than 100,000 or more than 100,000. And if people ever ask the reason why, I think it's, people need to save enough to get to the point where they can live on enough. They need to accumulate. And there are fiduciary and suitability laws rolling out that's saying they need to have enough liquidity outside of annuities. So we define a qualified lead over $100,000 outside of real estate for the most part of investable assets that's designed for retirement in some way. If you get heavier in technology, you can do data dips with one of the large, like Experian agencies that, it's not 100% accurate, but you can have like 70%, ping, where it gives you what their potential income is, what their the net worth is minus real estate by assets, what kind of leads towards a percentage of it. And that can be pretty efficient for people to opt in online. Now, some of the headwinds is everybody today is getting robo-dialers, meaning it's coming automatically with your cell phones, and that's the primary way people communicate. So having a way to follow up with people more than just a call is very important, and getting their permission so it's legal to be able to text them in case they don't answer your call. And there's little things like for a small amount of dollar, you can actually have your name or the name of your company show up on their caller ID when you call. I mean, it's pretty low cost. I think it's $15 a month. So they don't just think it's a random local area code or a random 800 number calling them for spam. So they can they're more likely to answer. So there's all those little things that you may need to do, because people, you got to get a conversation on the phone to start the process. And if you don't have a conversation on the phone, it's very difficult to start the process. So more than just looking at cost per lead or cost per qualified lead, I like to look at what does that cost for a conversation, a phone conversation? What does that cost for a sit-down presentation? Now, you're not going to put the same equal value via a Zoom one-on-one versus face-to-face. They're completely two different values. But we've had great advisors hit $18 million in sales 100% virtually in 1 year. So it's not that it can't happen. You just have to understand your matrices are different, and your follow-up has to be a lot more effective. And you might be spending a little bit more money on the marketing to get that sale virtually than in person. But it might be worth that work-life balance and way more efficient for you. So it can all back out.
Hey, Josh, you're getting all these leads through your own internal, like homegrown marketing, everything you're doing, the TV, the newspapers, et cetera. You're not buying leads.
We manufacture our leads. We've generated over 2 million leads over time. Now, they're not all good leads, right? There's a lot of poor data in there. So, and then a lot of times it's not if, it's when. There is so much value. If I went backwards 7 years ago, it made sense to spend more of our marketing dollars towards media and marketing and generating more leads. Today, it actually makes more sense to hire more account executives, people to follow up on those people that identified I have $1 million, and we call them once a quarter, check in with them, and get them new information that is timely as things change, whether it's taxes or things of that nature. So sometimes it's just a timing issue. Something happened in their life, but that constant follow-up is worth a lot. So a lot of the advisors that listen to this webinar today, that list that you have is very, very powerful. And it's powerful because you have a relationship with them. If someone else took that list, it may not be as powerful. The fact that you had a conversation, they raised their hand at some point and said, I want to get to anyone with information, it becomes a time. It's not now, but it could be later.
Yeah.
So Josh, I was going to say, Josh, looking at kind of a comparison between old school style of doing it, like doing seminars versus doing your television programs. And I know you do like hundreds of programs in different markets. So if you took a look at like one specific market, and obviously you're reaching a much broader audience than you would in that market versus doing a seminar, say you had 100 clients in the audience or prospects in the audience of a seminar, what would like the typical conversion to a client meeting be between those two, if you had like a local market spot versus a seminar?
Well, so I'm going to answer in a couple different ways. Pre-COVID, pre-COVID, let's just say you get 100 people over 2 nights to a live event. Getting a prospect to meet with you depends on your presentation skills and your connection, your ability to connect with them, and your ability to follow up. So a strong presenter might get 60-70% of the room to say, yes, I would like to opt in for a meeting. Now, remember, you bought them a meal, it's entertaining, they like it, everybody's saying yes because it's a herd mentality. And then what happens is people say, okay, well, I changed my mind or I'm sick. So out of the 60% that schedule a meeting, there will typically be about a 30%, 35% drop off of after people reschedule and cancel and change their mind. Some advisors a little bit less than that, some advisors a little bit more. If people actually track the math, and we track everything, we get about 50% of the people we schedule meetings with to actually show at the time and location that we all agreed upon. The other 20% will come from reschedules and follow-ups or things of that nature. Then the other 30%, they just change their mind. It kind of changes in that perspective. The financial show, like you're asking, that might play on a weekday or a weekend. It's 30 minutes. In fact, we just had a great show filmed with Tom Hagna and Alexis Glick, who's current news anchor on CNN as well as CNBC. And they really talked about why there's a need for longevity insurance, and there's a need for income annuities, a need for protected growth that are uncapped, and how some of them can pay extra money for home health care. And then there would be a call to action from the information kit to see if it makes sense for them from that perspective. So for those types of shows, depending on the quality and how much information you put in, your cost per lead can increase almost double, but then your conversion rate increase more than double too. So it's kind of something you have to put on an Excel spreadsheet and kind of measure as you go.
Yeah.
But there is a headwind with COVID. There is a headwind. People want the information. There is a financial sense of urgency. I will tell you, we have increased our conversion of meeting with somebody to doing business almost by 35% from a year ago. And the primary reason is because there's a financial sense of urgency. When we went from 5 employees to 90 employees in 1 year, from 2009 to 2010, is because of the market crash. We have had a drop, but we have not had a market crash, but people are concerned. When we do have a crash at one point, you can see another 4 years of tailwinds of people just really want to protect the money. We just haven't seen it yet.
Yeah. Hey, Josh, this was terrific. By the way, I think I saw that clip with Hegna. That looks great. I mean, your team puts together, a great show. Hey, listen, I want to thank you for your time here. We're kind of near the time. I mean, I just say, any last questions, Will or Mark or Ramsey?
So I'll just say thanks for your openness, and really fascinated by the methodical nature that you've built out your business, right? You demonstrate a ton of discipline, and it was very helpful to see how you use different sources of media, how the importance of having that diversification, and the way you track everything assiduously. So thank you very much for sharing that.
Thank you.
Yeah, Josh, really appreciate you you kind of coming on and telling your story. It's it's enlightening and inspiring as well. So thank you.
Good to see you guys.
Yeah, great to see you, Josh. Thank you again very much. I always appreciate your insights.
Yeah. Hey, thank you, Josh. And listen, we appreciate all the time the audience has given us. So thank you for listening. Give us feedback, and if there are guests you want to get on our show, send us a note, drop us a note. You can find us on LinkedIn or at the show site itself. So thanks again, and tune again next week for another episode of That Annuity Show.
Thanks for listening. If you've enjoyed the show, please rate and recommend us on iTunes, Stitcher, Overcast, or wherever you get your podcasts. You can also get more information at thatannuityshow.com.